name is Michael Scott Forehand. Today is the 30th of May, 2024. Wow, this year is flying by. And today we're going to be doing an infinite banking and debt-free life presentation. We've got a lot of folks with us, but we've got Ruth Slingo is going to be one of our special guests today, as well as Mark Creighton. Mark Creighton is a regional vice president with Mutual Trust Life, and he's a gentleman that offers, his company offers one of the, in my opinion, one of the best programs out there to use infinite banking strategies with. And I know that, Mark, you've been doing this a long time, and even I think you were with Nelson Nash's group. You probably trained them. I'm pretty sure you trained them how to do infinite banking. Just a little bit, right? So let's go ahead and get rolling here. Let me go ahead and share my screen. Well, actually, I need to do one thing. That's what I need to do. All right, so I'm going to go ahead and share my screen again, and boom. Hi there. Welcome to this week's edition of Debt-Free Life Infinite Banking. So let's go ahead and get started. Debt-free life and infinite banking, they are one and the same thing. You also, from time to time, you'll hear it called private banking or private bank, infinite bank, debt-free life bank. They're all the same thing. And really all they are is a specialized type of life insurance that allows you to store and grow cash in a place where the IRS can't touch it, tax it, or see it, as long as it's structured correctly. And some of the folks that have been trained on how to structure these programs, life insurance agents, brokers, underwriters that are professionals, have been trained on how to structure them correctly so they do not become taxable if that's a concern. The other version of these that does become taxable is called a MEC, Modified Endowment Contract. And those versions, as long as you're prepared for it, a MEC is not necessarily a bad thing. It just means that it doesn't have that tax benefit that we're looking for, a non-taxable program. So let's keep going. All right, so first two questions we ask about when we're looking at determining whether or not an infinite bank or a private bank or a debt-free life bank is appropriate for you are these two things that you see on your screen right now. Are you 100% certain you're going to have a great retirement, or do you have some doubt? And the only people other than myself who happens to be very pompous about this, who know that they're going to have a great retirement, most everybody should not be able to answer that question yes. And the other question is, if we could show you a way to get out of debt in 7 to 9 years or less, would you be interested? And of course, the answer to that question is for everybody, should be. If you have debt, then you should want to get out of it. The only person I know that routinely bangs the drum where it's a good thing to keep debt is Robert Kiyosaki. I do ascribe to a lot of what Robert Kiyosaki talks about and teaches and preaches. However, I still feel for the majority of the country, having debt is a bad thing. So we're gonna try to keep the debt monster away, and that's a symmetry thing if you are familiar with the debt monster. All right, so let's keep going. So if you're like most Americans, you have been told a lie, or you have been planning for your retirement not in the manner that you should have. A lot of Americans who have a 401k, TSP first, KEO, 403, whatever, retirement program like that, they're assuming that program is going to be enough for them along with Social Security. And if you've been following the news, you know that Social Security is going to be bankrupt in 2035. Now they actually did some changes to push it back a year. And for those of us that will not be receiving Social Security by that time, we're not gonna. So they're going to do something, but it's certainly not going to be paying out the way that it was thought to. So where the normal thought previously was, if I can save a small portion of my income over time, that I should be able to have a nice solid retirement, that is unfortunately not the case anymore. And if you're the normal American, like you see on your screen right now, you're spending a ton of money on interest and taxes. 74% of every dollar that you make, 74 cents of every dollar is being spent on interest and taxes over time. This is not a good recipe for a solid retirement. This is not the way our founding fathers saw this country. And this is not going to turn out well unless you start making some other changes. And if you're only living on 23% of what you actually make, then that leaves a very small amount for retirement, which is only 3%. And that's certainly not enough. Ruth, do you think 3% of somebody's income is enough money to retire on?
No, the answer to that is no.
The answer is no. So if I said, Ruth, look, we're going to go ahead and save 3% of our income for the next 20 years, because that's what we're going to retire with. How long do you think that's going to last?
A year?
Ding, ding, winner. So yeah, folks, the problem is the methodologies we've been using to do financial planning and retirement planning for the last 20 or 30 years, the rules changed. The interest that we're earning, it's not as good as it was thought to be. And the amount of taxes we're paying, it's much higher than we thought it was going to be. So 3% is not going to make it. So if you are like most Americans, you make a decent amount of money. The average American makes $2 million in their lifetime. That slide's old. This is a 4-year-old slide, and it's probably closer to 2.3 or 2.4 at this point. So the average American makes plenty of money. The problem is we don't save it and we spend it wrong. And so, Ruth, if I could give you a program, if I could offer you an opportunity to buy something and keep the money that you used to buy it, would you want to do that program?
Yes, I would.
Yes. Yes, he would. Very good. Good answer, Ruth. Thank you.
No.
Yeah, you're doing good, Ruth. You're 2 for 2. All right.
Yay.
Yay, yay, you, right? All right. So the point is that 3% is not enough. You make plenty of money, you just don't spend it correctly and you don't save it correctly. And that's probably why you're here watching this video right now. So if this is where you are and you have a concern, like you're getting ready to, I don't know, 2 years from now, go buy a house and you want to make sure your credit's in order and you got all this debt that's hanging around your neck and what are you going to do about it? Then you go meet with a debt counselor. And a debt counselor or credit counselor is going to give you the list of items that you see on your screen right now. If you could save more, you probably would be. If you could spend less, you probably would be. Let's talk about consolidation for a second. Debt consolidations. This is the biggest ball of caca out there, right? Why would I take a bunch of smaller debts that are easier to manage and put them into one massive debt that it's going to take me forever to pay off? Why would I do that and completely eliminate one of the most powerful tools we have for debt elimination called a debt snowball? Why would I do that? So debt consolidation, bad idea, right? Debt negotiation, all right? Ruth, I don't care how much debt you have. Let's say you have a lot. Tell you what, why don't you let me destroy your credit for the next 7 years and I'll get them to write off some of that money that you owe. Is that a good deal?
That's a bad deal, Bob. Bad deal.
Right. That's debt negotiation, which is a bad idea. Hey, Ruth, look, I know you've got $50,000 in debt. How about this? Why don't we take that $50,000 in debt that you have and let's go replace it with $50,000 more of different debt. Is that sounding a good idea?
It doesn't, but this is what we're not taught, but you're right. Yeah. It doesn't. I mean, it doesn't unless you're educated.
If we did what I just said, if we refinanced your debt, your $50,000 of debt into another set of $50,000 of the debt, did we do anything? Do we make any headway? Are we still?
We lowered our monthly payments. We may have lowered the monthly payments. That's it.
Right. So that's not really helping. And most likely, if you did that, then we're probably doing some consolidation also, which is making it more difficult for you to get out of debt. So the point is that all these things that you see that you're going to hear from a credit counselor or a debt counselor, every single one of them is bad, with the exception of a debt snowball. I'm not saying they won't work. Some of them will work some of the time. None of them will work all of the time. And our system, our plan, our program, our debt-free life program will work every time as long as you follow the plan. It's really that simple. All right. Our better way, right? Our better way is to get you from the left side of your screen to the right side of your screen. I want to make it so that you're not spending just 23% of your monthly income on living. I want to make it 34%. I want to increase your cash flow. I want to decrease the amount of money you're spending on taxes. I want to decrease the amount of money you're spending on interest. And more importantly, I want to increase the amount of money you've got available for retirement. So Ruth, if we're saving only 3% in the previous example of our income, but now we're saving 15%. If I did that for 15 years, what do you think that's going to look like? 5 times as much, obviously.
A
Right?
lot better.
Yeah. So, this is the difference between having a $60,000 nest egg, which is what the average American has when they retire, $60,000, right? At 3%. This is the average of $60,000 for the current American right now versus having $300,000. Just the interest alone off that $300,000, that's actually an income stream. The interest off $60,000, that's enough for a steak dinner, right? And that's what we're talking about here. We're talking about spending, saving, and just basically using money more efficiently. What everybody's doing right this minute in their lives, everybody's out there, especially if you're punching a clock, hourly wage, you're working for money. And what we're trying to do here is we're trying to put you in a different situation where your money can work for you. All right. So how do we do it? Well, we're going to reduce the amount of interest you pay over time. We're going to reduce the amount of taxes you pay over time. We're going to get rid of all your debt, 9 years or less. Actually, the one I did last week was 2.8 years. And we're going to improve your cash flow. So that allows you to have a better quality of life. You can spend more money. You can go out to dinner more potentially. Or if you really are focused and you have a short length of time before you're retiring, that means you can really hammer your retirement programs and really build it up quickly and give you a tax favored income. Hey, Ruth, if you could choose a tax favored income program that was tax deferred, pay the tax now, or tax exempt, which one would you choose? Tax deferred, taxed, or no tax?
Taxed.
You would pay tax? No, Ruth. Maybe I didn't ask the question right.
You didn't ask the question right. Say it again.
All right. So if you could choose a tax exempt program, a taxed program, or a tax deferred program, which one would you choose?
Exempt.
Okay. Why does everyone choose the tax deferred then? Everybody chooses the 401k. Everybody chooses the 403.
I know.
They're not educated. Right. And that's our job, is to help educate people. All right. So there's a lot of programs out there, Ruth. There's programs that call themselves infinite banks, and you're going to see a lot of those that are built on chassis, life insurance programs that are built on indexed universal life programs. Let me ask you a very simple question, Ruth, regarding an indexed universal life program. What's my interest going to be on that IUL in 2 years?
Well, we can presume certain things, but we are not guaranteed certain things. So I don't know 100%.
So you don't know? All right. How about 5 years?
I can do an illustration for you, Scott, but I don't know 100% exactly what it's going to be, but I can tell you what
let's do it in a shorter period of time. What's the interest I'm going to earn on that IUL in 1 year?
Not 100% certain.
Right. So the problem with IULs is you have no 100% certainty there's going to be any gain. And when you map out the gain of IULs versus infinite banks, there's one glaring problem. The minute you have 1 or 2 years, which does happen, of a flat market, the infinite bank then outperforms the IUL forever, and it can't catch up. Mathematically, it can't catch up. That's the difference. That's why we don't use IULs. Hey, Ruth, is the cost of an IUL program going to increase over time? The cost of insurance?
Yes, it will.
Yeah. So again, another reason why we don't like to use IULs for these programs, because the cost of insurance, the underlying cost of insurance, is going to increase over time in an IUL, which means towards the end, unless you've been overfunding it really, really high on a high level, then it's going to start eating away at the cash value of the program and eventually potentially cause it to fail. So that's the problem with IULs. We can't use them because I don't know. I can't make a plan of what my debt's going to look like in the future. I don't know, because I can't guarantee there's going to be any income or there's going to be any growth unless I put it into an all cash position And typically the all cash position is going to be less than I could earn with a savings account. So it doesn't make any sense to do it. All right. That's
Question
one.
for you, Scott.
Say again?
Question for you.
Sure.
Why does the age group of the client matter? Typically, I hear that for younger couples, the IUL is the better way to go.
Right. So it depends on when you're looking at a jump off point. Okay. So if you have the growth is a huge question mark with IULs. So if you're not using it as a debt elimination tool,
Right.
you're using it as a growth tool, and you're very young, the IUL is usually the better way to go. If you're using it as a debt elimination tool, then you don't know when you're going to eliminate your debt.
Gotcha.
You can't plan it because you don't know what the performance is going to be. So there's different things for different people. And this program is about debt-free life, which means we're assuming you've got some debt. So by default, off the bat, an IUL is probably not going to be the right choice in a debt-free life program. Okay.
And typically the very young have a lot of debt.
Maybe. Depends on who you're talking to. Again, just depends on who you're talking to. All right. So another one of the quote unquote infinite banks that's out there uses what's called a sweeps campaign, which is a very old tool that you had to, they're very expensive to set up. And what that does is it moves money from one account into another account between 11:59 p.m. and 12:01 a.m. And then it moves it back. And then so basically it appears that you've got money in two places. You've got your money in your active checking account earning nothing. Then you've got money in a savings account earning something, and you still have 100% access to all your money. The problem with those programs is the software is very expensive, and you have to be moving a whole lot of money to be able to get any kind of gain. The last one I ever saw about 6 years ago, it took 7 years to break even on the cost of the software. So it's probably not a good idea. And then there's different versions out there also that are based on what are a mortgage, essentially a home equity line of credit. Hey, Ruth, let me ask you this. What's the interest rate on my home equity line of credit going to be in 6 years?
I don't know.
Okay. Well, do you think it's going to be up or down?
Up.
Do you know if it's going to be up or down?
I don't know.
Right. So again, home equity line of credit, two things to realize about those versions of infinite banks. Number one, and this is also called the Australian model. This is a type of mortgage they have been doing for years in Australia. The problem with it is the loan rates are variable. And the second problem with it is you're sacrificing equity, or you're risking equity in your property to be able to eliminate debt. And if your debt happens to include anything other than your property, then you're risking equity in your property for something that has no right to equity. So the HELOC version of these programs is a really bad idea. I've got a client that we just started working with. She bought into this about 3 years ago when the rates were really low, and she had a HELOC that had a quote unquote fixed rate of 2%. Not a bad idea. Except now it's 8.65%, and she can barely make the interest only payment on that line of credit that she built in. So that's the danger of those HELOCs. And I have there's some talk about what's going to happen with interest rates and whether or not the Fed's going to lower it or not lower it, or when they're going to lower it and all that other stuff. And the reality is the interest rates that we saw 3 or 4 years ago, it's never going back there, not in my lifetime. And the reality with that translates to is I'm never going to get as good of a mortgage rate as I could have gotten 3 years ago. So it doesn't make any sense. And with the numbers that we're talking about here, the average cost of money with these programs right now, I'm looking at 2.1%. I don't know anywhere that you can go get a loan for 2.1%. So anyway, sorry, been on a rant. The 80-20 rule. So the 80-20 rule for us in the debt-free life program is that we actually create an emergency fund within your Infinite Bank. And what you can see is 80% of the value of your program. What the reality is that there's a little bit more on top. That's the emergency fund. And that I don't mean I need to go up to a cabin and go glamping in off Interstate 81 near Massanutten. I don't need to go do that. That's not an emergency. Okay. I don't need to take a trip to Tahiti. It's not an emergency. An emergency would be my best friend's father just passed. They don't have enough money to bury him, much less keep the house from being foreclosed on. They need money now. That's an emergency. All right. This is something we were talking about just a few minutes ago, Ruth. Remember that? Tax deferred, tax free, taxed.
Yeah.
Yep. This is what it looks like if you take the same variable, the same amount of money, invest it for the same period of time with the same amount of interest at the same tax rate. This is what the numbers flesh out to be. So obviously, in the tax-free world is the best way to go, simply because you're growing at a good interest rate, and you're not gonna underperform, or you're not gonna, the cost of taxes and deferring the cost of taxes, which means you're also deferring the growth in taxes. That's not going to kill me in a tax exempt program. Okay, let's be clear for this for just a second. This is a financial tool. It is like all financial instruments that work in phases, and the three primary phases are maximization, accumulation, distribution. We are talking about a debt-free life program, a debt-free life style of Infinite Bank here, which means there's debt, which means the debt is causing you, or whoever we're talking to right this minute, it's causing that individual to have a reduced rate of growth in their retirement program. Our goal is to get you off this debt hamster wheel and get you to the point where you're running at the same pace you were running before, but now you're actually throwing money into retirement and able to have a more solid retirement, or maybe get that boat, or maybe go fishing 3 times a year instead of just once every other year, whatever your thing is that you're going to do when you're retired. And so the accumulation phase is when you are out of debt. We're still working, we're still making money, we're out of debt, which means we can be more focused on the growth of our retirement programs. And finally, distribution. That means I can take that emergency trip to Tahiti anytime I want. That's the distribution phase, when we're taking money out of the program, we're distributing it. And Ruth, I am, wow, I got an AARP thing in the mail the other day. I was so angry, so angry. All right. So infinite banks, debt-free life banks, private banks, they're all the same thing. They're not new. They've been around for a long time. Rockefeller did the first one back in 1904. There's some other people on your screen right now that you've seen have done these. This is not my idea. This is their idea. I just happen to love it because it works. It's worked for me. I've eliminated hundreds of thousands of dollars of debt with my infinite bank over the last 6 years. All right. So these are the bullet points about what we do and how we do it and why we do it. We're not asking you to take on a new bill. That's not what this is about. This is just repurposing the money that you're already spending, most likely spending it inefficiently. We're going to change, instead of you paying $20 extra on your charge card every month because you think it's helping you, we're going to put that $20 into a program that's going to work for you for the rest of your life, not just the one time. We're going to spend the same dollars over and over and over. It's called dollar cycling. All right. Yeah, my stuff. These are, wow, this is an old slide. Those numbers that you see, eliminated 84,000, eliminated 73,000, that's very, very light. I'm looking at hundreds of thousands of dollars as a minimum in general that we're eliminating with these programs, because you're talking about mortgages now. So the one I looked at the other day was $564,000 is what they owed, but that's not really what they owed. They owed almost $1 million with the scheduled interest that was in there. All right. To understand how these programs work, the first thing you need to do is you need to understand how you spend money. So this is how you spend money. You make money, however you make it, 1099, W-2, W-4, stealing it from your uncle's purse, whatever, however you make money. You deposit that money into your checking account, and your bank loves you for it because your bank then takes your money and lends it out. And they lend it out every night at the federal funds rate or higher. The average dollar you put into your checking account or savings account, your bank makes somewhere between 60 and 70 cents with. It's pretty high. That's the dirty secret about banks. They make more money with your deposits than lending you money. And that's how they're making on both ends, because they're lending you money too, and they're charging you for the loan. So the bank makes money with your money. The average length of time that you leave money in your bank is about 7 days. And then after you've let the bank use your money for 7 days, and oh, by the way, they'll say something nice like, hey, Ruth, thank you very much for keeping at least $2,000 in your bank account with our bank and letting us use your money every night and make money with your money every night. And because you gave us at least $2,000, we're not going to charge you a fee. Yeah. That's the bank mentality. And then finally, you say, you know what? I need to go ahead and pay that bill. So you say, go ahead and pay that bill. And at that point, what happens is your money, which was sitting in your bank account for 7 days, making money for your bank for 7 days, now it becomes their money, whoever they is, the creditor. And that money's gone forever. And I don't care if you're the nicest person in the world, and you're the salt of the earth, and you give people the shirt off your back, and you are sweet and humble. And when you ask that lender or that creditor for the money back, they are not going to give it to you. It's gone. It is their money now. They'll be happy to lend it to you again, though. So this is a debt-free life bank. This is how it's different. So the same process, you make money, it gets deposited to your checking account. The bank sees the money, they get their hands all sweaty because they're getting ready to start making money with your money, right? But no, this is where we change. We make a payment to our life insurance policy. Life insurance policy, right? That's what we said from the beginning. We're not doing the HELOC version. We're not doing the IUL version. We're doing the whole life version, participating whole life. The very first one, Rockefeller, 1904. Whole life. But the program that we're using actually is a hybrid. And it's got two other riders. It's got a term rider and it's got a paid up addition rider. So let me explain what these things do. The whole life is the core policy. The term rider adds an inordinate amount of death benefit. Traditionally, it's up to 10 times whatever the whole life piece is. So if the whole life death benefit is $50,000, then the term life rider can be up to $500,000. And why that's important is because it creates volume within the private bank, within the infinite bank. It makes it so we can throw more money in there. And then finally, paid up additions. What is that? That's the more money, folks. Pretty simple. So when you're doing this and you're throwing the money into the paid up additions, what you're doing is you're buying more life insurance. This is important because the carrier says, oh, you just gave me another $1,000 to buy permanent life insurance. Okay, that means based on how old you are and how sick you are, I'm going to get to invest this money over and over and over again, make interest with this money a lot, and I'm going to give you some of it. I'm going to give you some of that interest. That's the beauty of this program. You are able to participate. That's why it's called participating whole life. You're able to participate with the success of that life insurance company. Hey, Ruth, if you drive into a big city and you see big, tall buildings in those big cities, usually there's a couple of different names you're going to see on the top of those buildings. Can you tell me what the two most common names at the top of those buildings are? What kind of businesses those are?
Insurance companies.
Yes, and banks.
Oh my God, I got it right.
You did.
Okay.
You're 3 for 4, Ruth. Everybody keeping score at home. Ruth is 3 for 4. Okay. So Yes, when you drive into any large city and you see big tall buildings, there's usually an insurance company at the name of the top of the building or a bank. It's one or the other. They are the two most profitable types of companies out there. Hey Ruth, have you ever known a bank to fail?
Yes,
Yeah. Can you name an insurance company that's failed?
I can't.
Yeah. So did any banks fail last year?
Yes,
Yeah. Can you name any insurance companies that failed last year?
no.
Can you name any insurance companies that have failed in the last 20 years?
I don't know of any,
No.
but
But here's the thing. From a business perspective, insurance companies are solid as long as they have good ratings. And they have to be solid because it's in their charter. They have to be able to pay claims and they have to be able not to hem and haw. They have to just pay it. Okay. If the person died and they're insured and the contract is in good order, they're going to pay the claim. And if they don't, then they're going to lose their charter. They're going to lose their license. They're not going to be able to offer and they're going to be out of business. It's that simple. So banks, banks fail all the time and they fail all the time because of their creative accounting practices that usually put them at risk. Okay. So the idea of where's my money safer? That question comes up all the time. It's actually safer in an insurance company than it is with a bank. But I've got $250,000 FDIC insurance. Yes, you do. And I've got 250 in this bank and that bank and this bank and that bank. Great. You're covered for 250 with each bank, right? No. 250 total. Okay, well, I've got some in the credit union too. Great. NCUA, right? Yep. 250 total. That's it. All right. So back to the screen. So this is what happens. Instead of the money sitting in your regular bank account, checking account, you actually make a premium payment. The premium payment hits the carrier. The carrier says, okay, well, this piece I'm going to put in this pocket. That's your whole life core policy. This smaller piece I'm going to put in this pocket. That's your term life piece. And this big, massive amount, that's your paid up addition. I'm going to go put this in the wheelbarrow and carry that out back and plant it. And then they're going to pay you interest, guaranteed interest on the PUA amount and a little tiny small amount that's embedded in the whole life. That's that emergency fund we were talking about. So all of a sudden, I changed the game. I'm no longer letting the bank make money with my money every night. Now what's happening is I'm making money because my money is now in my bank, my private bank, my infinite bank, my debt-free life bank. And when I take the money out, my money's still in there. Let me explain. So now we get to that point where we have to pay a debt. How do you do it? You take a loan. Take a loan from the carrier. I am using my cash value as collateral. I am borrowing against my cash value. Ruth, if my cash value is earning by contract 3% per year, and my loan cost is 5% per year, what's my net loan cost?
2%.
This many. 2%. Hey, Ruth, can you go anywhere right now and just because you want to do it, take a loan at only 2% interest? Anywhere.
That's negative.
No. So, you've got your best friend happens to be a branch vice president at the local XYZ bank, and you've known this person since you were 6 years old. Can you go up to that person and say, hey, give me a loan for 2% just because you know me?
No,
No?
no,
Okay. That's the beauty of an infinite bank. You can. Ruth, in an infinite bank, who makes the decision of whether or not you can borrow the money?
I do.
You do. Ruth, if you don't pay yourself back, are you going to take yourself to court?
Absolutely not.
No. Ruth, are you going to penalize yourself and send the feds after you if you don't pay back that debt?
No,
Okay.
no.
Okay. So this is the difference between taking loans from traditional banking systems versus taking a loan from an infinite bank. Your money's already collateralized. The money's in there, you're just using it, and now you're using it at a lower interest rate than you would if you had the best bank in the world and had the best relationship with the banker at that bank, and they were able to give you the best rate that you could get on the planet, you're not going to get it at less than 2%. So now you take in that loan. Money goes back into your checking account and it's time to pay that creditor, right? Yep. So you tell your bank, because you just took the loan from your infinite bank, you put the money back into your regular bank account and say, hey, Mr. Bank, please go ahead and pay that creditor. Okay. Ruth, it's on the screen. Is the creditor paid? Is your debt
Yeah,
paid? Yeah. Okay. Where's your money, Ruth?
it's gone.
Nope. Where's your money, Ruth?
Wait a minute. If you take it out of your checking account or you borrow it from your account, from
So
your cash value.
I put the money into my infinite bank.
Oh, yeah. Yeah. It's still in the infinite bank working for you.
Okay. So so my debt's paid and I still have my money.
Yes. Yes. That is accurate. Yes.
So if that debt was worth, let's say it was a $10,000 vehicle that I just paid off, right? So now I have 100% equity in that $10,000 vehicle, right?
Yeah.
And I still have my $10,000, right?
Yes.
Did I just increase my net wealth by $10,000?
Yes.
Yeah. So the point is here, folks, every time you make a payment using an infinite bank, not to the bank, but when you take money out of the infinite bank and actually send it to your creditor, every time you do that, you're increasing your net wealth because you're eliminating that debt and increasing the cash value. You're doing both at the same time. All right. So if you want to, we're not going to do this. We've done this 100 times. You can go back and look at any of the videos. It's the same clients. It's the same deal. You've got the fact is that you're going to be paying off the debt faster and eliminating debt faster and getting through the whole process faster and building up cash value faster and ultimately getting a larger, faster growing retirement program, which is the whole focus of this. So that's the end of our basic debt-free life presentation. That might be 6:18. Wow. I did that in 40 minutes. That's one of the fastest ones. Well, that's going to do the rest of it. All right. So now let's talk, right? Ms. Slingo, is there anything else that you would have added to that conversation, that presentation?
No, well, I say no and then I start talking. I do that every time. What I'd like to say is, let me just put it a little bit different way because my voice, I communicate a little differently than Scott, but I'll just say, do you want to pay tax on the seed and not have to pay tax on the harvest? Because that's what we do here. Do you like that? Wasn't that kind of good?
Did you come up with that? I love that one.
I know, right?
We're going to call that a Slingoism.
Okay, we can call it whatever you want. Just I think it's amazing. But no, paying tax on the seed versus paying tax on the harvest, because the deferred, you're paying tax on the harvest. So that's just one thought process. The other thing is, what we do day in and day out, and if you're a client or you're an agent, we provide a light at the end of the tunnel. See, there's debt. And with your debt, you're trying to do the best that you can based on all the data that's at you. Let's have an educational moment. Let's put your numbers down and let's show you your light at the end of the tunnel. How can we marry the infinite banking with the debt snowball concept? That's what we do here. Yep. It's a beautiful thing. We're keeping your current budget. We're just keeping your current budget. That's what we do. And we're not adding to your budget. And the benefits are you have a light at the end of the tunnel. You have someone teaming up with you to help you complete those goals to get out of debt. But you also have a death benefit. So your family's ultra protected and bulletproofed. So what is really the question mark here? Let's educate you. And while we're educating you, let's help you use your same dollar that you're using to get out of debt and build tax-free wealth retirement at the exact same time. It's really just that simple. I may have made it sound a little different than Scott, but really it's just that simple. So we need to put your numbers down and give you that light at the end of the tunnel.
Right on. Mr. Creighton, what do you got to add?
Howdy. I got good stuff. I'm going to hit on a few things. 401ks, I mean, they're really interesting. At one point in time when they were created, they kind of made a little bit of sense. Hey, I'm going to defer my income now while I'm at these massive tax brackets because when I make less, the tax would go down. We're in an inverse world right now. If you believe your tax rate is going down when you retire, well, I hope you're right. I'm not expecting that to be correct. So we're deferring income, paying taxes on income right now when we're at a historically low tax rate to pay it later when the government is going to decide what we owe them. It'll be fun. I can't wait. Two, there was a slide you put up, 3 phases of what you do. The third bullet point is almost the most important one that gets overlooked. It's the exit strategy one, because plans are great. Hey, this is a cool plan, but what's the exit strategy? 401ks, hey, they make sense. What's the exit strategy? What does this exactly look like? Oh, I don't know. We'll figure it out. But we're going to hold your money and not let you have it until then. Just wait.
Trust us, we're the government.
Trust us, we're the government. When you had the slide up there about all the other different methods that people can help you get out of debt, none of them really have an exit strategy. The closest one to it is the one that says save more money. Okay, that's helping you build wealth, but that's not talking about anything else. And the tying into this point, everybody understands PLI, permanent life insurance. Permanent life insurance is a beautiful thing when done the way the IRS wants you to do it, that it's still considered insurance. It is tax exempt. I'm going to build my cash values tax deferred, never pay taxes on anything. And they're going to allow me to use it, all that I put into it and the gain, and never pay taxes. Consider this. Let's imagine the hypothetical client wants to plan on retiring with $100,000 and they have climbed the mountain successfully and accumulated assets to spit out $100,000 a year out of their various accounts. There's taxable, there's not, there's whatever. Let's imagine it's all taxable, and let's just pretend for argument's sake they're in a 25% tax bracket. They're going to pay $25,000 in taxes on that $100,000. However, if they've utilized permanent life insurance to help them get out of debt, to grow that number to beyond what could have given them $100,000, what does that do to their taxes? Let's just say half of their retirement income is going to come from permanent life insurance. That's not disclosable on a tax return. So now they're claiming 50% income. And just assuming, for argument's sake, they're still in a 25% tax bracket, they're only paying 12.5 of taxes on the 50,000 they got to pay taxes on. They have 87.5 of the 100,000 they were going to take to live on. Permanent life insurance is the coolest thing. Other note, I was thinking about what you were saying about banks and the FDIC. Well, anytime you put the government in charge of something, college tuition, it gets more expensive. So banks, don't worry, we'll bail your clients out. Oh, well, geez, I got insurance from the government. I can do stupid things and go bankrupt and screw a business. Insurance, we don't have government backing. We have our own backing. We're very sensitive to public's perception of life insurance companies. You guys know it. I probably before you were ever in this business, you thought about life insurance and you're like, if I ever talk to a life insurance person, I'm going to punch him in the face. Now you are one. Kind of funny. It's the old
I'm a
joke
life insurance professional, thank you.
when you're on an airplane and want to make somebody stop talking to you, hey, I sell life insurance. Would you like some?
There you go.
But
Leave me alone.
we're very sensitive to the public perception of life insurance. So we've got something called the Guarantee Association, which basically says if a life insurance company does run into problems, there's an arrangement for other carriers to come in and pick them up. The clients will have everything in their contract the way it was promised to them. No client is going to go left uncared for. So that's all I got. That's
Right
fun.
on.
I like this. Different
Yeah.
stuff all the
Fun format. Well,
And I'm going to plug your cool event. These two spectacular souls are doing something next. And I left a message for Ruth earlier. I've got 2/3 of my pieces, but I don't know what I'm going to say about DFL. Now I do. I'm going to help you overcome some of the objections
there you go.
in a way that I don't think I've heard anybody talk about.
Awesome. Awesome.
You heard it here first. Mark Creighton's got some special info coming out at the, which one? Advanced Markets Workshop is for Mark. Yep. Next Thursday in Hopewell, Virginia. All right. Somebody wake up
Can't
Jim.
wait.
Andy's got his hand up.
Hey, Andy.
Yeah. Yeah, one of the things that we seldom talk about is the fact that in order to have an infinite bank, there is an outflow of cash to pay the premiums on the insurance. And as the resident cigar smoker, my premiums are fairly high.
Yeah. So are you making a statement that tobacco users have higher costs of life insurance?
Correct. But the costs, you have to recognize that there's a cost for creating your infinite bank.
Yeah, there's a cost. So, all right. So again, putting this
And
into your perspective.
That is a recurring cost until
you RPU it.
Yes, until your PUA is maxed out. You've paid in as much as.
No, there's a process in life insurance you could do called an RPU, which stands for reduced paid up. And what happens at that point, the total amount of death benefit decreases, but there's never another premium payment.
That's correct.
But it also means you can't keep adding to it, though.
Guaranteed contractually. You couldn't even pay a premium if you wanted.
That's right.
So what point would one consider
Right.
doing that?
That's a great question. And this is where Ruth, what Ruth does when she does her present. Go ahead, Ruth, because this is leads right into the way you do it.
So what happens is, Andy, is what I do at that point is when I find out what your budget is, and then I use your budget of anything because we're doing this for the Debt-Free Life program. That's what my initial concept is to talk to you about. So what I do is I find out, are you making any, well, let me just ask it like this. Are you a client or an agent?
Client.
Okay. Are you making any payments on the debt that you're trying to pay down to zero? Are you making any payments above the minimum or just paying what the bank asks for every month?
Well, I'm paying the my 2 3/4 mortgage regularly. I pay off my credit cards.
Yeah, but do you pay the minimum on the credit cards or more than the minimum?
No, I pay off the credit card every month.
Okay, perfect. And your mortgage, do you put extra to principal or just pay what the bank asks for?
Just what the bank asks for.
Okay, any other so what we do is we find in your budget right now, anything that's not being used, any dollars that are not being used as efficiently as possible, we utilize and cater your program to how much of that base amount we're going to use for the cost of insurance and how much, depending on how much you want to put into it, for how big of a umbrella of a cost of insurance that we even want. So everything's catered to the person that we exactly meet with.
And we're looking forward in time to see where your funding method and your funding level is going to give you the ability to pay those debts off one at a time.
That's correct.
They're all gone. And that's when your program might be 2.5 years. It might be 6 years. It might be 22 years.
Correct.
I don't know. Everyone's different because it's based on your health. It's based on your cost of insurance. It's based on your need. It's based on your ability to financially perform. And it's also, Andy, the things that we did are a little bit different than other folks because we used yours is more IBC retirement based.
Yeah.
So and retirement focused.
Focus.
And we're doing, duplication strategies
Different.
within you. So it's a little bit different. But that's the beauty of these programs is that there is no one size fits all. That's the beauty and the curse. There is no one size fits all. So you have to dig in deep and ask a ton of questions.
Mhm.
All right. Anybody else? I want to hear from Kevin Gable.
Annie's trying to talk and she's muted.
Annie.
Oh,
Hello,
sorry.
Ms. McKinnon.
Hi.
Where's
Hi.
Freddie?
Okay. He stopped by and well, I took all these notes and so he's
Okay.
got to run out. Sorry. But I have just a quick question. This is concerning when you borrow money against your life insurance and it goes into your banking account. Do you have to hurriedly pay the creditors before the bank gets the opportunity to use that money, let's say overnight?
That's up to you.
Or,
It's your
Oh.
deal.
okay.
It's up to you. It's your money. You do what you want to do with it. For me, there is a benefit to paying off whatever debt you're going to pay off, especially if there's a daily compounding associated with that debt. There is a benefit for you to pay the debt off as soon as possible.
Mhm.
What I'm saying to avoid the bank being able to use that money overnight, to loan it out to whoever, whatever. Maybe that part I don't need to worry about, but
You
just
don't.
go ahead and just pay my creditors
Yeah.
and
Worry
to
about
come
the things
get.
that you can control. And,
Okay.
go ahead, Mark.
Okay.
Having worked in a bank in a prior life, same life, just a long time ago, you just cause the bank headache by doing it. So do it. Because they're going to see your deposit and they're going to go, oh, we get to go spend it. And then it's going to come out of your bank account the next day or whenever that transaction comes. And then they're going to have to borrow money to cover their reserves and they're going to have to borrow it again. And so it's really kind of ruined their profit margins to do it.
So if
Super.
you
But
take it to the bank,
Scott's point-
do it as quickly as possible.
Yeah.
Scott's point is
Gotcha.
most accurate. You're going to reduce the interest charges from your other creditors. So you want to do it quick anyway.
Mhm.
All right.
Great questions.
Yep. Anybody else? So I said I wanted to hear from Kevin Gable. Kevin Gable, give us a Gable.
All right. I got so many good nuggets out of this. I don't get on these often enough, and sometimes I don't get as much out as I think I should. But that's all on me. But this was just such good stuff. Pay tax on the seed, not the harvest. Ruth, that was great. And Mark, the thing about you use your life insurance as income in retirement, which effectively cuts your income tax rate overall because you don't have to report it to the IRS. I never thought of that. There's just that, and I didn't realize that the life insurance companies are in a system where, God forbid, something does happen, the other life insurance companies have to pick
That was good.
it up.
They
It's good to know more.
Isn't that a co-insurance process, Mark?
It's something about a guarantee association, insurance guarantee association. There's a name for it. It's in place. If you Googled it a little bit, you could probably find some information, but I assure you, we will not let anything happen to a carrier that they will come in and bail out. What basically happens is carriers come in and buy segments of their book of business.
Yep.
Hey, this is the kind of client we like. We're going to buy that. This is the kind of client we like. We're going to buy that. And, the clients basically end up with the same policy, but it's serviced by a new carrier. So,
Yeah. Just good stuff. I mean, we're in the business. We ought to have some idea of how the things work. So it's good to know.
it would be a massive black eye for all of us if a carrier went belly up.
No, I get it. And just the whole idea back to the 401ks, they were created in a different time, a different age. And as you said, that they may have been really good back then. Those days.
Yeah, Brenna, Johnson & Johnson, 1970.
I was going to bring up another point. Sorry, Kevin, to further support this. we are regulated by regulators. We have to have, as Scott was saying, we have to meet the obligations of our clients. That's cash, death benefit. There's a bunch of things. And we are required to have a certain level of our money on reserve and readily available to pay what we need to pay. We and really all your good whole life companies have multiples of what we are required to have a good rating. So we could have 100% of what they want and we could get a good rating. We have, I don't know, somewhere around 500%, 5 times what we're required to have. You're good. Most of us can all tell you we're all between 400 and 600%. It's just further assurance that we are here for the long haul. We were open during the Great Depression. Insurance companies did not call a bank holiday. We stayed open because we could.
Hey, Mark, your
Yeah.
company during the Great Depression, did you guys still pay a dividend?
Yes, we did.
Hey, Mark,
I
dur-
remember the day we announced it.
during the Spanish flu, the first pandemic for this country, did you guys still pay a dividend?
Yes.
During every war since 1904 and every policing action, you guys still paid a dividend?
Yes.
Yeah. Okay.
And as a high net worth investor, the thing I like about insurance companies is they are the best managers of risk, of financial risk. And they're the only financial institution that uses the fact that some people die early, which means your costs go down. And that goes into the dividend.
You
So
lost.
the age risk is carried on those of us who refuse to die.
All right. All right.
That- Oh, wait, Chase has a
Chase.
question really quick. I'm sorry. Thanks, Chase.
Hey, Scott. I have a lot of young people who are interested in this, and it's hard for me to explain to them how they would pour into it first to be able to get out the money to pay the bills that they currently have and the debts.
All right.
How much would,
Hold on. So what you
Okay.
just described, there's different types of infinite banks. You have a
Mhm.
debt-free life bank where we're using it to cycle through and pay off debts. And then you have a cash flow bank, which means we have bills we're trying to pay from this, which is not the same thing as a debt-free life or an infinite bank. They have to be structured differently. So don't get them confused. Okay?
Okay.
Don't go. I didn't mean to cut you off. I wanted to nip that in the bud though before you started talking about a cash flow bank, which is not what we on this. We don't teach that here. We do them. That's not what this program is about. This is about debt-free life.
so the debt-free life, so whenever they can immediately draw out the same amount, or is there a cap? How does that look?
Every
When
single
it
one is
comes,
different.
okay,
Okay, first off, and every person's different. So I don't know because you have to give me a specific. If you tell me that someone's paying $100 a month and their cost of insurance is only $20 a month, then there's $80 a month that's going into cash growth. Can they take $80? No, they can take about 90% of it on the very next minute. So it just
that's what I needed to know.
Okay.
Yeah, that was the question there. I just didn't know how to verbalize it because I've not
No worries.
experienced nothing.
Yep, no worries. And Chase, in the very beginning, because I know you're a fairly new agent, I would not be one who's trying to present these for you right now. I would get with a Ruslingo or with somebody else on your team that's familiar with these, that's certified. Because we have to, in order to do this, you have to be certified. Okay. So make sure you get with somebody like that that can walk you through it or walk through it with you is really what it should be. Okay. In general, to become DFL certified here, you're going to have to do at least 10 of these with somebody else who's done hundreds of these before you can get your certification. So it's good to know it. It's good to ask questions. That's why we're here, but don't stress out too much about being able to say exactly the right thing. And you can always, I'll self-plug, you can always point them to the YouTube channel and they can go watch some of these videos.
Yeah, it's not something I'm planning on jumping into right now. It's
Okay.
just out of curiosity, just to build
Sure.
my knowledge over time.
Yep. Yep. When are you starting yours?
Well, my wife's an accountant. She keeps asking me a bunch of questions. So
Yeah. You guys should
that's
have
it.
one. Yeah. All right. Anything else? Anybody? Wow. 17 minutes.
Mark is talking away, but he was muted.
I was
Okay,
amateur. Chase, your wife would be an incredible source of referrals.
that's
Get her
correct.
on board.
That's correct.
A
And-
CPA friend who gets IBC. Oh,
Yeah.
special people.
Mhm.
And we're not talking short bus special.
she would be driving the bus. That's how good she is.
Oh, snap. It's awesome.
All right. Well, without any additional questions, Mr. Creighton, any last words?
You know, we think about things and getting out of debt, like whether you're doing it the traditional way, the way everybody hears about, or whether you're going to do DFL the better way. It's a discipline. If the client really wants to get out of debt, they have to be disciplined. If you've ever experienced it, ever seen it, or you go through it the first time with a client, what you're going to realize, it might be painful. You worry about where you're going to get the premiums from and how they're going to do it. But when they see the results of the discipline early, nothing's going to get in their way. Anybody ever hear the first rule of getting to your retirement goal is you pay yourself first? Whatever percentage of your income you're saving, you should put that away first. That's the only way you can actually get somewhere. We don't do that as a society. I'm going to go out and have fun. It's payday. Hitting the pub. Going to go have some fun. We're going out to dinner. I'm going to take my wife dancing. We're going to have all kinds of fun. And then by the end of the paycheck, by the end of the pay week, 2 weeks, what do I got left? I got $5. I got 3% of my money left. That's what I'm going to save. Doesn't work. That's why that's why people only save 3%. You pay yourself first. You start doing this. You commit to the program. You're going to be out of debt. You're going to save buckets, truckloads of money. And that money's going to work for you later on. And once they start, they won't stop. They see the light at the end of the tunnel. You're helping them get out of debt, and you're putting a plan in place for retirement. So when Social Security gets axed completely or delayed because somebody has to do something about it, this is not a party issue. It is a bipartisan problem, and neither one of the sides of the aisle wants to pull the trigger on this, but somebody's going to have to at some point. And there are advisors, there's smart money people in Wall Street saying, the idea of retiring at 65 was because you used to die at 67. So congratulations, go enjoy 2 years. It is not a birthright. However, if you're blessed to do so, if you've worked hard and accumulated wealth, yeah, I want to retire at 65. I want to go travel the world and do things, but how am I going to pay for it? Social Security isn't going to be something I have to lean on. I've got to do it myself. And guess what's going to get me there? PLI.
Paid up life insurance.
Thank you.
Yep.
That's all.
Thanks, Mark. Annie, you want to say anything? Because I see you're unmuted.
No, I'm good. I'm just listening.
All right. Miss
Yep.
Ruth, you got the last words, dear.
I am not following Mark Creighton. It's been wonderful hanging out with you guys. PLI. No. I thoroughly enjoy communicating with people that get it. And Chase, I'm just gonna throw this out there. A year and a half after I got certified, before I did my first DFL by myself, a year afterwards, I started hanging on Scott's shoulder and splitting everything before there was a FIF reset program, splitting everything with Scott so that I could learn. And how do you get good at anything? You do it again and again and again, and you learn from someone who's done it again and again. So this is just what we do here, but education and being able to properly put these things in place and cater them to the people that you're sitting in front of, listening for their needs and finding out what works for them and what's in their budget is going to make all the difference in the world. So I love this.
Well, that was Ruslingo. My name is Scott Forehand. Thanks for hanging out on a Thursday night. If you're an agent, please go out and help some families. If you're a client, thank you very much for trusting us enough with your money and letting us help you get to wherever you're trying to go. We'll be back next month. And for those of you that will be at the Hopewell event, I'll see you in a week. Bye.
Thanks. Great.
Thank you.